Legendary investor Ron Barron interviewed Elon Musk in person this week. Barron is worth about $4.9 billion, and he's the founder of Barron Capital, which has approximately $45 billion in assets under management. Last year, it was reported that his fund had made $4 billion off of Tesla alone, having bought it around $13 per share, and he sold some for his funds, but it's still a massive holding. What's amazing about Barron's investment strategy is that he doesn't follow traditional rules given the size of his fund, and he basically does what he wants. Many funds cap their investment size to 5 or 10% of the fund. Take ARK Invest, for example, which uses a 10% cap. So while Tesla stock was on its way up over the past few years, they were selling frantically to try to keep the holding under 10%. Ron Barron doesn't do this. Today, Tesla still makes up an astounding 40% of his Barron Partners fund, and he's the major investor in all of his own funds. Ron Barron told CNBC that of the $4 billion of Tesla stock that his funds own today, he personally holds about a quarter of that, which appears to make Tesla about 20% of his net worth. Now Ron Barron believes that after his monstrous 16 times return on Tesla, even after this massive sell-off, he thinks the stock still has far more upside and can multiply his return by at least a factor of 7 times over the next decade. And before we continue, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and financial data going back 10 years, and it's all freely available. During Ron Barron's interview with Elon Musk, he emphasizes something that is still important in today's EV market, which is that just a few years ago, no one wanted an electric car, and if it wasn't for Elon Musk and Tesla, there wouldn't be any electric cars. But even today, automakers are not making electric vehicles by choice. They're essentially being forced to make them, and every time they sell an electric car, that's one less car that they can make money on. Now, the logic here follows that in order to compete with Tesla, if you're pricing your vehicle the same as them, then you're likely losing money. And if you charge a premium in order to be profitable, then the vehicle isn't going to be priced competitively. So that's one reason why competitors are struggling to be profitable. But it's not exactly just about price in order to be profitable, and Ron Barron may be very right about competitors losing money on each EV that they sell, even if they claim to be profitable. Most of Tesla's competitors have extremely low EV volumes, meaning that their investments in electric vehicles, such as spending billions on repurposing or building new factories, etc., have in no way paid for themselves yet. And so Ron Barron describes that these other OEMs have enormous amounts of money invested in ICE vehicle infrastructure, which again supports his point that no one wants these cars except for Elon. Now, Elon Musk goes on to say, Tesla is best at manufacturing in the auto industry, which I think no one was expecting. And Barron replies, probably in the history of the world, and Elon agrees. So Ron Barron seems more bullish than even Elon, and the claim is also backed up by the productivity of Tesla's factories, particularly the Fremont factory, which is the highest of any auto plant, including ICE vehicles, in North America. So traditional automakers haven't been able to reach this level of production from a single factory with their 100 years of automobile manufacturing experience. EVs have proven to be more difficult for them to build, and yet Tesla is demolishing their internal combustion engine factory outputs with the equivalent of electric vehicle alien dreadnought factories. And it doesn't seem to be stopping there. Tesla's brand new Giga Texas factory is expected to be much larger than Fremont in terms of production in a few years' time. And Ron Barron also highlights his excitement with the incredible return on investment that Tesla has with its new Gigafactories. He states that Tesla invests around $7 billion and then gets $15 billion per year in return. And he's talking about profit, not revenue. If the factory can build 1 million vehicles a year at $50,000 each, which is indeed Tesla's average revenue per vehicle, that's $50 billion of revenue, for which Barron estimates 30% operating margins. So $15 billion per year perpetually into the future just from a $7 billion investment. And Barron may even be underestimating this, since Elon Musk said in the past that he's targeting 2 million cars per year from each of these new factories. Now, in order to get there, Tesla would likely need a much more affordable car in order to address a larger portion of the market. Sam Corris of ARK Invest estimates that moving from a $60,000 vehicle to $30,000 increases the market size by 5 times, giving access to 50% of potential car buyers. And so Ron Barron asks Elon Musk, how do you get to a $20,000 car? Elon says he hasn't formally announced that yet, but Tesla is planning to make a more affordable car than the Model 3 or Model Y, which we already know, but he focuses on autonomy actually being the biggest factor here. Given a 5 times increase in the usage of the vehicle, meaning fewer parking lots and even fewer cars. And later on, Elon Musk refers to autonomy as a breakthrough, saying that no one is even close to Tesla. And so autonomous driving will offer the next leg up for expanding Tesla's size and profitability when it comes to fruition, since it's all high-margin software revenue. Elon says autonomy makes cars 5 times more useful for the same thing. Nothing extra needs to be added to today's Tesla vehicles, since Tesla's strategy has been to include the capability in all vehicles that they produce. So that will give them massive leverage to effectively flip the switch and enable full self-driving at no extra cost beyond what they're spending today. And this is different than competitors who can't do this because they rely on expensive LiDAR and other sensors, which has limited their ability to scale. Solving full self-driving will be extremely lucrative, and Tesla will actually be able to make money in many different ways. They get money from the initial FSD purchase. Right now that's $15,000, and it will likely be higher when FSD works better than a human. Currently, this amount is already at least partially baked into Tesla's current sales. There's also a portion that goes into deferred revenue, since Tesla has yet to deliver the final product. But when they do, the revenue per vehicle will increase because all of FSD will be counted in each sale. Then there's the Tesla Robotaxi network, where Tesla can take a cut, say 30%, from every drive on the Tesla network. Elon says in this interview, do the free cash flow and it's insane. And so imagine Tesla making a few cents from every mile driven by a subset of their vehicles that have 5 times the usability of a regular car. This is completely incremental to their current revenue streams. Full self-driving will also have other implications as well. I've highlighted in a more in-depth video on how it changes the game for Tesla's insurance product. I think it completely eliminates the need for all of the traditional data collection that insurance companies use, like your gender, age, your car color. It doesn't matter anymore if FSD can basically just watch you drive and directly rate how safe you are in each situation. And so good drivers will benefit immensely and save money, but at the same time, Tesla will have the safest cars and still be collecting insurance premiums. And fourth, autonomous driving can further reduce Tesla's cost per vehicle. Right now, Tesla needs a human to either ship the car or load it onto a truck to be shipped longer distances. And we're seeing right now in the most recent quarter that Tesla has had to put more cars in transit as they try to smooth out deliveries, since they quickly use up all of their resources during peak times, which always occurs near the end of each quarter. With FSD, Elon says to Ron Barron, if you're in the area, have the car just drive to you. Imagine the impact that this could have on Tesla's delivery logistics. And of course, trucks that carry cars can be autonomous as well, bringing vehicles closer to where they need to be delivered, and then have the vehicle itself do the last mile drive. If Tesla can do this, it will greatly reduce the logistics costs, which are currently baked into the cost of the vehicle, and so it will further boost Tesla's margins. Now, Ron Barron also had an interview with CNBC where he recites what Elon Musk said about Tesla being worth more than Apple and Saudi Aramco combined, which is about $4.4 trillion in value. When CNBC host Becky Quick asks if he believes that Tesla can achieve that, Ron Barron doesn't hesitate for a second as he confirms his belief. He gives a back-of-the-napkin calculation to get to $4.5 trillion in 10 years. Tesla's goal is 20 million cars per year at $50,000 per car, which is $1 trillion in revenue. He assumes 30% margins, so $300 billion, with a 15 times earnings multiple, and that's $4.5 trillion. Now, first of all, the $50,000 per car in revenue may be a bit high, since that's about the average price of a Tesla today. And in order for Tesla to get to 20 million cars, they simply can't sell $50,000 cars to everyone. The market can't support that. So a $25,000 or $30,000 car would help get them to that number, but would lower the average price. Now, Tesla does have a few levers that it can use to push the average price higher. For instance, the Cybertruck, Semi, and Roadster could help raise the average. But I still think that a $30,000 car at high volume, more than all of Tesla's other products combined, would still push the average price down. But that said, Ron Barron is using a 15 times multiple. Even today's large tech companies like Google, Apple, and Microsoft trade at much higher than 15 times earnings. But I think it's also important to note that the car business alone could become saturated at that level of sales. But even today's stable companies like Coke or Pepsi trade at 25 times earnings, so stability could become more important at that time. Nevertheless, it's interesting that Barron sees how Tesla can get in the ballpark of $4.5 trillion with just cars alone. Ron Barron also recognizes that it doesn't include robots, autonomous vehicles, and batteries. As just discussed, autonomous is not only an additional business on top of what Tesla has today, but it will drastically increase the margins on the vehicle side. So with FSD in play, Ron Barron doesn't need to be right about the average selling price. He just needs higher margins, and Tesla's auto business can easily be worth multiple trillions. At that time in the future, around 2030, if Tesla is scaling cars to these levels of volume, the landscape will also be very different. Tesla is starting today, or actually a year ago, with a humanoid robot, and so the progress made by 2030 could be astounding. Even Andrej Karpathy on the Lex Fridman podcast notes that a lot of software on the Optimus robot is a copy-paste from Tesla's full self-driving software, pushing them ahead very quickly. Elon Musk reiterated this about the Optimus program to Ron Barron, saying that Tesla is leveraging manufacturing and their self-driving intelligence to have a useful humanoid robot. He says that if GDP is GDP per capita times capita, and if you have no limit on capita, then it's not clear if there is any limit to the size of the economy. Elon has said this before, but the calculation is quite simple to outline his thinking. And so this was part of his response to someone who asked a question about why should he buy Tesla at 70 times earnings versus Mercedes at 6 times earnings. And Elon refers to autonomy and the Optimus robot in his response. But really, this person isn't factoring in the growth rates of each company. PE ratios are fairly useless without growth. If Mercedes is in decline, then 6 times earnings could be too expensive. On the other hand, if Tesla is growing vehicles at 40 to 50% per year, and therefore earnings are close to doubling each year, then the PE ratio drops very quickly after just a year or two, thanks to a continued massive growth rate. So do you think autonomous driving cars will mean fewer cars on the road since utilization will go up perhaps 5 times, as Elon Musk says? Or will there actually be more cars since the cost per mile will be so low that things like public transit and food and package delivery will make much more sense to shift to a low-cost point-to-point solution? Please hit the like button and subscribe. We would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.